Look, if you're a finance student or frankly just anyone paying attention to the markets, you've seen the headlines. Another day, another tech startup gets crowned a unicorn with a dazzling $1 billion, $10 billion, or maybe even a $100 billion valuation. But how often have you looked at one of these companies, noticed they're barely their revenue, and thought, wait, mathematically, how is that even possible? Well, welcome to this explainer. Today, we're putting those mythical price tags under the microscope. We're going to break down the actual financial engineering behind private market valuations and show you exactly why that massive billion-dollar number might just be a carefully constructed mirage. To do that, we've got a four-part roadmap today. First, the billion-dollar illusion. Second, the math behind the myth. Third, the rise of the zombies. And fourth, the public market reality.
Let's jump right into section 1, the billion-dollar illusion and why the math just doesn't add up.
50%. Let that sink in for a second. Research actually shows the average unicorn is overvalued by a whopping 50%. And honestly, it gets crazier because some are inflated by over 100%. We are not talking about a slight rounding error here. We're talking about a massive systemic distortion. So when you see a headline shouting that a private company is worth $1 billion, there's a very high statistical probability that its true market worth is absolutely nowhere near that number.
The core reason for this gap really comes down to price discovery. Think about public stocks for a minute. They're stress-tested continuously, literally second, by thousands of buyers and sellers reacting to real-world economic realities. That is true price discovery. But private valuations? They are highly illiquid, paper calculations made behind closed doors by a tiny group of negotiators. Without a public market to constantly fact-check a company's worth, these private numbers basically get frozen in time at their absolute peak fundraising metrics.
Okay, section 2, the math behind the myth, where we look at the financial engineering at work. So how do they actually arrive at these frozen, inflated numbers? It comes down to a neat little mathematical trick called the last-in pricing distortion. It's a three-step process. Step 1, venture capitalists step up and pay a massive premium for a very small batch of new, preferred shares. Step 2, the startup takes that premium price and just multiplies it by every single existing share, including the basic common stock held by early employees. And Step 3, they proudly announce that massive inflated total valuation to the press. Assuming that every regular common share is worth the exact same as a highly protected preferred share is frankly complete mathematical fiction. Now you might be wondering, why would VCs agree to these absurd premium prices in the first place? Well, it's because they aren't actually taking on the risk that the headline price implies. They use structural mechanisms to protect themselves. You've got liquidation preferences, which basically guarantee that new investors get their money back first if the company goes under. Downside protected. Then there are ratchet clauses, which promise VCs free extra shares to make up the difference if the eventual IPO price comes in lower. And finally, structured deals that bake in guaranteed revenue, compounding interest, or redemption rights. So these mechanisms completely distort reality because they essentially de-risk the deal for the VC, making it super safe for them to sign off on a massive artificial headline price. Why play this game at all, right? It's all about incentives. Founders love it because a high valuation brings immense prestige and serious recruitment power. And the VCs? They absolutely need to show high paper returns, those mark-to-market gains, to their own investors. A portfolio packed with billion-dollar unicorns makes it infinitely easier to raise capital for their next fund. The illusion works perfectly for everyone sitting at the negotiating table, right up until the check comes due.
Which brings us to section 3, the rise of the zombies, the undead startup landscape.
Back in 2021 and 2022, zero interest rates fueled this massive fundraising party. But now, the hangover is here. Ilya Strabilai over at Stanford pulled data on 1,900 unicorns, and it is pretty grim. 332 of them recently had to raise money at or below their peak valuation, but the real kicker, 383 of them haven't disclosed a single dime of new funding in 3 years. Now sure, maybe a few are profitable, but a lot of these are what the industry calls zombie unicorns. They're completely trapped. They can't raise fresh capital because there's just no way they can justify those mythical 2021 valuations to today's cautious market. Let's look at a real-world example to put this into perspective. Remember Cameo, the app where you pay celebrities for quick shout-out videos? Back in the 2021 pandemic surge, they were minted as a unicorn with a sparkling $1 billion valuation. Today, reality has hit, and it hit hard. The company is now estimated to be worth just $82 million. That is a brutal crash back down to earth, caused entirely by the fact that the business was wildly overrated when money was cheap and flowing freely.
And hey, it's not just pandemic fads. Take a look at Quora, a much more established platform. Back in 2017, they were valued at $1.7 billion. Fast forward to 2024, they had to raise money at just a $500 million valuation. And that's even with a desperate pivot into the AI hype. Startups are having to accept massive valuation haircuts just to survive right now. As Quora's boss even admitted, they had to accept being marked to this new market reality.
So we are left with this paralyzing trap. VC fundraising absolutely tanked from $223 billion in 2022 to just $66 billion last year. Investors are spooked, especially since older VC funds are currently underperforming the S&P 500. So what do the VCs do? Well, since their agreements usually give them veto power over an IPO, they'll just block a company from going public if it means exposing that true lower price. They would much rather keep the startup paralyzed as a zombie in the private markets than take a very public hit to their paper returns. It actually makes sense when you realize that just 5% of VC firms are producing 90% of the industry's profits. They have a reputation to protect.
Which leads us to our final act, Section 4, the public market reality, where gravity takes hold.
Eventually, these companies have to face the music. They go public, get bought out, or run out of cash. And the structural corrections, they're devastating. First, you have the IPO discount. When a unicorn finally hits the public market, all those artificial VC protections get stripped away, and public investors almost always price the company significantly lower than its private rounds. But what if they run out of cash privately? That triggers a down round. Remember those structural traps we talked about? Down rounds trigger anti-dilution protections. That means late-stage VCs just get more shares to protect their initial bet, while the common stock held by early employees gets completely wiped out. The collateral damage is massive. In fact, PitchBook expects to see between $500 billion and $1 trillion in net valuation cuts across the board as these older startups are finally forced to reprice or go bust.
So, knowing all this, how should a skeptical finance student actually define a unicorn valuation? Well, it's definitely not an objective measure of current worth. It is simply a highly illiquid, structured bet on a company's future potential, heavily optimized for marketing and fundraising momentum. It's a financial product designed to sell a narrative. It is not a reflection of fundamental reality.
Which brings us to the ultimate question, the one you need to ask yourself the very next time you read a headline hyping up the newest billion-dollar startup. When you look at those staggering numbers, are you investing in a company's reality or just its marketing momentum? Keep that in mind the next time you see a unicorn roaming Silicon Valley. Thanks for joining me on this explainer, and keep questioning the math.